Hi, I'm Peter Switzer. Welcome to the program which puts you in touch with the best from brose minds in the business. On tonight's show, after 12 days up and 2 days where the market does not look really keen to sell off, are we looking at a better year for stocks? Let's see if Contango's Chief Investment Officer, George Boubouras, is setting himself up for a good year, and we'll get his take on how worried he is about his beloved Greece. If you're invested in Santos and other coal seam gas businesses, you'll have to watch Alan Jones, who outlines why he is crusading against the CSG industry. We'll see how an international fund manager is looking at overseas stocks, with the ECB at long last mounting its QE program with K2 Asset Management's Nick Griffin. And we'll find out how a new boy on the energy block is faring with energy prices plummeting with Real Energy's Scott Brown. Stay with us for the next hour and we'll bring you all the latest corporate news and market analysis, plus learn some valuable lessons from Australian success stories. If you have any questions for me or our guests, email them to switzer@switzer.com.au. You can follow me on Twitter and the handle is @PeterSwitzer. But first, with reporting season really hotting up, how is Contango Asset Management CIO George Boubouras preparing for the show and tell that lies ahead? Is he positive, negative or neutral on what companies will reveal, and what's his overall view on the market for the year ahead? George, thanks for joining us.
Peter, good to be here.
Now, George, we've had 12 up days, and they were great up days, then two small sell-offs, and it followed the rate cut and a bit of an improvement in the oil price. Is this the value of a rate cut, George?
Yes, Peter, in part is the value of the rate cut, and the value of long bond rates also being lower. So when you put the lower for longer long bond rate through the valuation model, when you put lower cash rates and expectations of cash rates to be lower again going forward, that obviously creates a valuation sort of angle where there is some opportunity for some dividend payers, some REITs, some banks, etc., to continue to perform because they're relative good performers. And another way to look at it is, for other people out there in reporting season, with obviously the rally in the past 12 days, equity valuations are more expensive, obviously. But that's one way of looking at it versus a month ago and 3 months ago and even 2 weeks ago. But when you look at and you apply the long bond rate much lower, when you look at an earning yield versus a bond yield, and you're looking at one asset class versus the other for evaluation methodology, it still says that you should be overweight equities on a one-year view, as hard as it is to believe. And that's what it does. It shocks all the valuations, and that's what it tells you going forward. But volatility will be elevated in the year ahead in that sort of framework.
Yeah. Okay. Now, George, let's look at tomorrow. We've got Domino's, CSL, Boral, CBA, Goodman Fielder, Primary Healthcare, AGL, Gemworth, Oz Minerals, Computer Share. It's a huge day. Of course, the star is going to be CBA. Are you looking to see, as I think Paul Rickard described it, an opening jaws where the revenue is increasing at a faster rate than expenses?
Yes, very much. Look, CBA will, as it always has, deliver in line or slightly above, and that's what it can do. It's the world's most expensive bank for a reason, and it's obviously the market darling at the moment. So not expecting too many surprises from there. I'll be looking at their impairments and what they're going to talk about on the corporate credit cycle in the year ahead, because remember a lot of the banks increased impairment charges and then removed them last year, so obviously to help with that earnings outlook. But no surprises from there. Would expect no surprises. Another one to look for will be Stockland as well. Should expect no surprises from there in the REIT sector. So very busy day tomorrow. Domino's needs to confirm its extraordinarily expensive valuation because they're very, very good at what they do. And then Computer Share, obviously, it's been quite weak in recent weeks because it's obviously a global play, so with lower Aussie dollar it's a positive, but obviously lower interest rates globally is also a negative for that play. And they need to be better at exercising and bringing out that cost-out structure when they're acquiring different sort of companies. So Computer Share has had a bit of a sell-off, obviously, in recent weeks as well. So people will be looking at the detail there. I mean, it's just a plethora of reporting stocks, obviously, tomorrow and this week in general. Yeah.
George, are you expecting the earnings to surprise on the high side? And if you're not, is the really important takeaway message from all reporting season the outlook statements, particularly with lower interest rates and a lower dollar?
Yeah, the first part of that question, I'm expecting earnings to be lower than consensus for this fiscal year. Because it's been dragged down by metals and mining and some consumer staples, notably Woolworths, has dragged down the EPS forecast, not to confuse anyone. So we're lowering the base in the current reporting season. But when you lower the base in the current reporting season and you have lower cash rate outlook and a lower bond rate outlook, that improves the fiscal 16 outlook, obviously, because it's going to be higher off a lower base.
Yeah.
So to give numbers out there to people that follow it, consensus going into this reporting season for fiscal year 15 for the earnings per share of the whole market was around about 3%, 3.5%. That will be probably 1% or lower by the end of this period. But the positive is in fiscal year 16, that bounces up to about 8.5%, possibly 9% because of the lower base. So that's what it means. And you're buying today the earnings in the end of this year or fiscal year 16. That's the key here.
Yeah.
And that is what I'm always trying to gauge it. Therefore, when you apply that, I still think on balance, the guidance is vital from any company that gives guidance to help you gauge whether that rebound in the EPS, which should come through the lower rates, is going to be delivered. So earnings certainty is key, Peter. That is why CBA tomorrow is a key play, because it's going to meet expectations. Stockland should meet expectations. Computershare has not met expectations.
Yeah.
And that's what earnings is all about.
Yeah, and so if you're looking at the great buying we've seen over the 12 days, part of it would have been that story you put together that we're expecting better EPS for fiscal 2016. Also, the rate cut would have helped. Do you think the possible future rate cut is already in the market, or is only partially in the market? They still have to see it before they'll react to it.
Yeah, good question. The futures market's pricing it in by mid-year, of course, but the equity market has partially put it in.
Yeah.
So the next rate cut means a rally. It won't be an 80-point rally like it was last Tuesday, but it will be a rally nevertheless. Because remember, the Aussie equity market, for most of your viewers out there, they're very used to a good quality dividend yield, higher payout ratios in their portfolio that reflects the ASX 200. That's going to continue. But the dividend yields of the past are going to be migrating lower in line with lower bond rates and obviously lower cash rates. They can't be elevated. So, but you know, the bias is going to be fed. That's probably what I'm trying to say. For those seeking income in retirement, self-managed super funds that are exercising the pension phase, you know, they will be searching for yield. They can still go out there and get that yield and be clever around the franking strategy as well.
George, let's talk about your beloved Greece. Are they going to be a significant curveball that could knock around the optimism that this conversation has been resting on?
Yeah, it is a curveball, or a Shane Warne flipper, or whatever you want to call it. But you know, going into March, they've got some key negotiations there. But it's very unfortunate. One positive, Peter, is that if you translated the Greek headlines into English, the market would sell off much more, because the Greek Syriza party is very far leftist, very far left. So they're using some sort of, you know, I'd call it Marxist language. So it is a bit of a shock to some free market participants. But I'm glad that not all the quotes are translated. But it is going to be a curveball. Some of the language is very, very strong still, and I'm disappointed because on your show 2 weeks ago, I pointed out that I thought the adversarial language would drop away now that we're in government. It has dropped away a little bit, but it's still quite feverish, and it's a little bit unfortunate from it's very non-market friendly. But like I said, I'm glad that everyone's not translating it word for word. That is the curveball, and it's a bit unfortunate. And that is why risk assets in parts of Europe are a little bit elevated. That's why the Greek equity market's been selling off. And it's why credit spreads in some parts of Europe are higher than where they were a month ago, when they should be lower if the risk on trade permeates through all asset classes. So yes, I am concerned. I won't translate exactly word for word, but I mean, some of the stuff the finance minister's saying is it's very enlightening, and it's pretty much out of Che Guevara's handbook.
Okay, right. Well, one last one quickly. Are you happy to hear the possibility that the Putin-Ukraine thing may be hosed down, the problems and the pressures there?
Yeah, of course, and that's a big geopolitical risk. The Russians have lost so much money, firstly on the fiscal side from the energy slide, and also because of the sanctions that started obviously at the beginning or towards the end of last year. They're really taken a negative effect. That economy is really crippled. So these were consequences a lot of people, political analysts, were pointing out would happen as a natural consequence of being squeezed financially. So there are good signs, of course, and it's a positive development. But the Greeks have obviously gone in there to sort of fulfil that unknown variable, and I think they're enjoying it at the moment, unfortunately.
Okay, mate. Thanks for joining us. Talk to you soon.
Cheerio.
After the break, radio broadcaster Alan Jones explains why he's so anti-business when it comes to the coal seam gas industry.